Morning, Steve Free in Chicago with the morning grain comments. I think markets are lower overnight. It's kind of that part of the week in which we start looking at demand for U.S. Corn, bean, and wheat exports and ethanol demand. And again, some people are worried that with Brazil harvest moving along, their export prices tanking, uh, their export prices $1 below U.S. Gulf, that our soybean export demand could slow. We also note that for the corn and wheat, talk of higher global interest rates, maybe some of the lower currencies and some of the importing countries could slow their demand for corn and wheat. And with the competition of maybe from Ukraine corn and eventually Brazil corn, Argentina corn, and from Russia wheat, that those markets could add to our carryout. And then in 2023, assuming some kind of normal weather pattern in the U.S., trend yield in corn could be up 5% or 185 million bushels per acre as a national average. It's a long way away, a lot of weather to trade, but it just seems like today is kind of a gut check for the bulls in a lot of commodity markets. Stocks look to be open up a little bit lower, while the dollar is a little bit higher. Crude is down maybe because of concern more about demand than the decline in Russian production. I think that when we sit back and kind of look at the overall trade, mostly volume is down. Hedgers are trying to use options from a long position in beans, corn, and wheat as a hedge against us breaking out above the 1550 area. $7 in corn, moving higher in hard red rental wheat prices over $9 versus following this type of rally. And I think that the end users, for the most part, and the speculators could see lower prices, but willing to risk some kind of hedge in the options in case Mother Nature does not cooperate in 2023 at some key crop areas. So basically chopping around, waiting for demand numbers, and also watching to see if higher global interest rates and lower currencies by importers impacts demand for U.S. exports.